Good morning, ladies and gentlemen. Thank you very much for dialing on. What I want to do is talk about an addendum to the greenwashing topic today, which is risk washing. Risk washing is something that's not exclusive to ESG investing. I think it's prevalent to the whole market. Essentially, risk washing is looking at the risk within one's portfolio and how much it's taking for the returns that you're getting, and importantly, versus the name on the door of the profile that you're buying. So what I've done here is I put forward a few points just to kind of illustrate that. But essentially, as an example, which I've got in a slide coming up, is one investor can buy what they believe is a balanced portfolio, and they believe for their clients they are achieving a balanced investment for that client. But actually, when they look under the hood into the fund or the portfolio, they can see that they're taking varied levels of equity exposure, and equity exposure is akin to risk. So you can find in a balanced mandate that some clients, some managers will be taking 30% equity exposure. Some in extreme will be taking 75% equity exposure. Yet the name on the door for that product can be balanced. It is, to an extent, misleading because it is not showing you the true nature of the investments that lie under that name. And that's what we coin the term risk washing. They're calling it balanced, and they're washing the risk that they may be taking. They may be over-risking a client portfolio, yet via calling it balanced, they're making out that it's a more balanced mandate. That is something that we disagree with. So I've put here, do investors know what is in a name? Do you know what you're taking when you buy a balanced portfolio? Do you know what you're taking when you buy an adventurous portfolio or a defensive portfolio? We believe it's critical in this day and age to make sure it's not only looking at the headline title of the portfolio, but what is in it. What does balanced, going on to the second point, what does balanced mean to you and your clients? What does your client want? Do they want a balanced mandate, or do they want a risk-balanced mandate? We believe that they're very different things. If your client wants a balanced approach to risk, we don't believe that taking a portfolio with 75% equity exposure is appropriate. Yet it is still called balanced. It's something that we want to watch out for. Underneath that, I've put the relationship between returns and risk needs to be better understood. Over the last 5 years, I've seen plenty of portfolios that call themselves balanced, delivering market-beating returns. But it's obvious why they've generated those market-beating returns when you look at the level of risk that they're taking. It's obvious that the ones that are taking 75% risk have massively outperformed. We do get some clients coming back to us and saying, well, why should I own your portfolio that's a balanced portfolio when I can own a portfolio over here that's returned 20, 30% more than you have? And the answer is simple. Well, go and look at how much risk they're taking. And it's very obvious when you do that, you can see how they're achieving that. But again, you must understand that the risk that's being taken in that portfolio is far greater, which means when volatility turns up, that portfolio will underperform much more and much sharper than a more balanced mandate. When it comes to ESG investing, I think this could get worse. I think for a number of reasons it could get worse in the ESG market. The ESG market is a tighter investment set. Yes, it's still becoming more broad. It's becoming more mainstream in terms of ESG investing, but there are less products in the market. Investment managers could be tempted to increase their exposure to various different funds because of lack of choice, and therefore increase a client's risk exposure, yet still call it a balanced ESG mandate. Yet we believe that it could be, you could be moving further up the risk scale. So what we're doing here is we're talking about risk washing. Obviously, TAM takes this very seriously, and we believe we have an answer to risk washing, but this is something that we think is prevalent in the market. I'm going to move on now to a very quick diagram, an illustration, if you will, of what I'm talking about. So all of these portfolios are balanced. They're all called balanced. One is taking 40% equity. One is taking 50% equity and the other is taking 85% equity. And these are products in the market. We've not named them, obviously, apart from us in the middle. So 40% equity, we would say, is a slightly more defensive approach. 50% equity, where TAM is what we believe is balanced. 50-50, it makes sense to us. 85% equity, we have seen managers calling this a balanced approach to investments. 85% for us is fundamentally an adventurous, high-risk portfolio. Yet, any manager or investor looking at these three, and looking at the balanced mandate, looking at the returns, might pick the one on the very right because it's returned the most, yet it's still called balanced. That, we believe, is inherently risky because you're not looking at the underlying portfolio. So, very quickly, our assessment of risk. TAM sees risk in an absolute measure. We see it versus our benchmark. How much risk is our benchmark taking? We want to take a lower level of risk than that. We are not happy with taking a higher level of risk than our benchmark because it is what we stick to. It's one of the core pillars of how we invest. The benchmarks that TAM look at are whole of market benchmarks. FTSE All World, FTSE All Share, government debt. Very, very mainstream benign indexes. And we seek to always generate returns lower than that. What is important to us when it comes to risk? It's important that we're delivering the risk level that our clients signed on for. Our clients did not sign on for a balanced mandate. They signed on for a level of risk. That level of risk is a balanced level. So it's important to us that when we're expressing balanced, cautious, growth, adventurous, those are just names. Underneath that is the level of volatility that we're exposing them to. And that for us is critical. So I've put here what is important for you as advisors to watch out for, not only in ESG investing, but in mainstream, is to look under the hood. I urge you to look under the hood of the models and the portfolios that are running and see how the returns are being generated. Make sure that you're happy with the level of risk that's being taken to achieve those long-term returns. Because if the market turns against you and you have a balanced mandate that is over-risking itself, you need to be aware of that when you're investing for your clients. Now, TAM obviously makes sure that we have extremely detailed, laid out approaches to risk. Remember, don't be afraid to ask questions. Whether that's with TAM, whether that's with another manager, make sure you're looking at the investment composition and you're asking the questions about how they achieve their exposure. It's very important. Performance is something here that we've put down in our mainstream portfolios. It's akin to our ESG portfolios. The returns we're very happy with, especially when you consider that they are we take a balanced approach to risk. So every single one of these staggers up, as you can see. As we take more risk, the returns increase. You don't start to get outliers jumping ahead of other portfolios because we are playing around with the risk more in one model than another. This, I just want to highlight from these investments that we are taking a measured approach to risk, and you can see that sequentially moving up as we go through the timelines. So to conclude, whilst an expanding ESG fund universe is positive, there is a risk of greenwashing, absolutely, and we need to watch out for it. As TAM, as investment managers, we are doing that on behalf of our clients. Calls for in-depth analysis and significant due diligence, absolutely, that's only going to increase. ESG investors must look past short-term noise and focus on long-term growth opportunity. At the end of the day, we are long-term investment managers seeking to invest a portfolio for you and your clients for the long term, not the short term. ESG is a fantastic opportunity long term. Finally, risk washing, mainly in comparison of apples and pears. Don't be afraid to ask questions. You need to understand on behalf of your clients how the exposure and returns are being generated. Make sure you ask questions. They're there to answer them. Thank you very much. What we're going to do now is hand back over to Joe for some questions.